Medicare IRMAA is the fee or surcharge on top of the standard base premiums that you pay for Medicare's Part B and Part D. These surcharges can be upwards of $2,000 per person per year, or even upwards of $8,000 per person per year based on your situation. So today we're going to talk about 5 ways to potentially reduce or eliminate these extra surcharges on your Medicare Part B and Part D. Thanks for joining our channel. My name is Scott Sierens. I run a retirement planning and investment management firm where we help families and individuals, people just like you, understand when they can retire, how much they can spend in retirement, how to reduce the taxes on their IRAs, 401ks, and 403bs, all to help them maximize their retirement story. So IRMAA, or Income Related Monthly Adjusted Amount, is a monthly increase to your Medicare Part B and Medicare Part D standard monthly premiums. So basically, you're paying more than the standard amount for Medicare's Part B and D. Now, if you're watching this video, I'm sure you've heard of IRMAA because you're probably feeling the pain of those surcharges on your Medicare. But before we go into the 5 ways to reduce or eliminate it, it's important that you understand a few key things about IRMAA, what it is, how it's calculated, different tiers, before we go into the 5 ways to reduce and eliminate. So whether you're subject to IRMAA and then how much of a surcharge you're subject to is all based on your modified adjusted gross income. So for instance, if you are filing as a single, for example, right now in 2023, one of the tiers is from $103,000 to $129,000. If your modified adjusted gross income falls in that tier, you're going to pay one level of surcharge for your IRMAA. Same thing is filing single. If you're from $129,000 to $161,000, that's a whole different tier or level of surcharge that you're going to pay on your Part B and Part D premiums. Same thing, if you're married filing jointly, there's a tier from right now $206,000 to $258,000, 2023, $258,000 to $322,000 is another tier. These will change year by year. So what I'd recommend is, going to the internet and searching IRMAA, IRMAA, IRMAA tiers for Medicare premiums. And based on whatever year you're watching this, you'll see the tiers for that specific year. Also, when I said modified adjusted gross income, it's actually a specific Medicare modified adjusted gross income. And I just want to make sure I'm going to read these off to you so that way you have it very straight of what it's based off of. Like I said, a few key parts to understand before we go into the 5 ways to reduce and eliminate. So what the Medicare specific modified adjusted gross income is your adjusted gross income plus tax exempt interest. So if you thought that you're putting money in, municipal bonds to help you steer clear of IRMAA, unfortunately, it's not helping you out. Now, it might be helping you out from a tax standpoint, but it's not helping you out from an IRMAA standpoint. So adjusted gross income plus tax exempt interest plus interest from U.S. savings bonds plus earned income from U.S. citizens living abroad that has not been claimed, and then plus income from sources not in your adjusted gross income. And then it goes through here and says like Puerto Rico, Guam, American Samoa, or Northern Mariana Islands. And then there's one more key ingredient to understand when it comes to Medicare IRMAA, which is the 2-year, I'll call it 2-year look back rule. Meaning right now we're in 2023. So if you're paying IRMAA in 2023, well, that was all based on your 2021 taxes. That's why I call it kind of that 2-year look back or 2-year look forward. 2-year rule is 2023 IRMAA was based on your 2021 taxes. So your 2024 taxes will determine your 2026 IRMAA. So here's why those were some key parts to know. Knowing this means that we know that if we reduce our taxable income, then we're also helping to reduce or eliminate Medicare IRMAA. All right, so with that, let's dive into the 5 ways to potentially reduce or eliminate the IRMAA, those extra fees, painful surcharges on your Medicare Part B and D. All right, the first way to potentially reduce or eliminate those IRMAA surcharges would be by utilizing qualified charitable distributions or QCDs. You see, if you're age 70 and a half or older, you can give directly from your IRA to a charity. That's called a QCD, Qualified Charitable Distribution. You see, this really becomes helpful when you have to start taking those required minimum distributions from your IRA, because all of those RMDs actually add to your taxable income. And when that adds to your taxable income, it might throw you into one of those tiers where you now have to start paying IRMAA surcharges. So how does this become handy? Well, use the QCD to give some or all of that RMD to a charity. You no longer have that taxable income going in on your taxes. Now you're lowering your taxable income, potentially getting you out of those IRMAA brackets and out of those IRMAA surcharges. So for example, let's just say your required minimum distribution this year is going to be $100,000. And you've already done a tax projection, so you know that at $76,000 of taxable income from this RMD, you're going to have to pay IRMAA surcharges. Well, $100,000, you're for sure going to have to pay IRMAA surcharges. And I don't know your situation, so again, this is just a hypothetical example. Well, if this person in this hypothetical example gives $25,000 of their RMD to a charity, now that's $25,000 less of taxable income. They're now only having to take $75,000 as the remaining RMD that they have to take as taxable income. We said 76 is where they cross over into the threshold. They're at 75,000. Guess what? No IRMAA surcharges in regards to that. Again, hypothetical scenario, but hopefully you can see how you can use QCDs to lower your taxable income and potentially keep you out of the IRMAA surcharge brackets. Number 2 is doing a donor advised fund. A donor advised fund is where you take and make a lump sum contribution into a donor advised fund, which is specific for charitable giving purposes. Now, you don't have to give it all in 1 year. You can give it over your lifetime. And there's more that we can go into in regards to donor advised funds, but today is the focus on IRMAA. Now, when you do that, you actually get to take and get basically a deduction on your taxes for that lump sum contribution that you made for the donor advised fund. So that lump sum deduction that you're going to be able to take, that could also help you reduce or eliminate the potential of getting the IRMAA surcharges for your Part B and Part D premiums. Now, donor advised funds are a little bit more complex, so speak with your tax professional as well as your financial professional to fully understand how to do it and if it would actually benefit you in your situation. All right, as we go into number 3, if you're finding value and benefit in this video so far, and you want to know additional ways to save on taxes, to save on Medicare, subscribe to our YouTube channel so that way you get notified as we come out with new videos each week. So number 3, let's just say you are still working. Number 3 is by making contributions to tax-deferred accounts like IRAs, 401ks, 403bs. You see, because when you make those contributions to a tax-deferred account, you actually get a tax deduction for the year that you put that contribution in. So let's go back to our example. Let's say you have, instead of an RMD coming in, you have $100,000 of wage income coming in. And you know that this $100,000 is going to throw you over, again, hypothetical example, going to throw you over the limit or the threshold where then you're going to be subject to Medicare IRMAA. Well, from your $100,000 of wages, maybe you were working at a company where you can contribute to a 401k or a 403b. Let's say you put $20,000 into that 401k. Well, now instead of $100,000 of taxable income, you have $80,000 of taxable income. And maybe just by doing that, you were able to keep yourself under the threshold of having to be subject to those painful premium surcharges for Medicare Part B and D. Now, everybody's situation is unique and different, so this is why you want to be doing a tax projection for your situation to know where you're going to potentially stand by the end of the year, so you know how much you might need to contribute, not only just for your retirement, but also to keep yourself out of those potential IRMAA surcharges. All right, the 4th way to potentially reduce or eliminate those IRMAA surcharges would be Roth conversions between the years from when you retire to when you have to start taking required minimum distributions. You might be thinking, wait a second, I've been on your channel before and I know Roth conversions add to taxable income. You are correct. When you do that Roth conversion, you pay tax today. But maybe based on your tax projection and how much you've saved into IRAs and 401ks and 403bs, when you start looking at the required minimum distributions that you're going to have to take in your 70s and 80s and years beyond, you might look at it and go, wow, because of that, I'm going to be subject to IRMAA all in my 70s, all in my 80s, all in my 90s. So maybe in these, we'll call it gap years between retirement and RMDs, if you're at a lower taxable income, you might want to start converting some of that money out of that IRA. Again, taking a strategic approach. Maybe you're going up to an IRMAA threshold, but not going over it. Now you're getting money out of that IRA, out of potentially having to take required minimum distributions later on in life, and over to your Roth. So doing that, now you're increasing the value of your Roth, your tax-free money, and you're reducing the value of your IRAs and 401ks, which means that you're reducing the value of future required minimum distributions. So that's how Roth conversions can potentially help you reduce your IRMAA surcharges in your future, but by taking a really strategic approach when it comes to it. All right, before we talk about number 5, if you're here listening about IRMAA, I'm guessing you've got a decent amount of taxable income coming in, which also means you're subject to a decent amount of taxes. So one thing that you might find of value and benefit is our free guide to unlocking hidden tax savings opportunities. You can get it at lifemoneyshow.com/taxes. Again, lifemoneyshow.com/taxes. All right, let's talk about the 5th way to potentially reduce or eliminate IRMAA on your Medicare Part B and D. And number 5 is filing an IRMAA appeal based on a life-changing event, such as marriage, divorce, or loss of a spouse. Those are all things that would potentially change your tax brackets and how much income that you actually have coming in. The other thing is work stoppage or work reduction. Hey, that's retirement. You can potentially file an appeal based on your retirement. You know, this is something that we've helped clients out with because what we recognize is that they're going into retirement making a really good income, and then once they retire, they no longer have that wage earnings coming in anymore. So again, it's looking 2 years back, always looking 2 years back. And so you can file an appeal to say, hey, this year I retired. I don't have all that income coming in anymore. And depending on your situation, by filing that appeal, they might accept your appeal and reduce your IRMAA surcharges because you no longer have that wage income coming in anymore. I hope that you found all of these of value and benefit for your specific situation to help you reduce your IRMAA and reduce your taxable income. If so, subscribe to our YouTube channel as we're coming out with new videos each and every week on retirement topics like Social Security, like Medicare, like reducing the taxes on your IRAs and 401ks. So by subscribing, you'll get notified as we come out with those new videos to help you and your future. Thanks, and have a great day.